Hi. Hi, everybody. Is this your intro?
Hey everyone, welcome to the Dean Adler team weekly Zoom webinar. We are very happy that you guys are joining us. We're just starting and I wanted to remind everyone that this call is being recorded. And if anyone would like a copy of it at the end, all you gotta do is shoot us an email. We're gonna put the email on the chat box. During the webinar, if you have any questions, you could either raise your hand, put it on the chat box, or by holding down your space bar, it's like a walkie-talkie, so you can actually talk and then you talk while you're pressing it, you're talking and then you release it. And we're doing this so that not everyone is speaking at the same time. And I think that's all I have to say, other than Dean is going to be speaking to us today about credit, our credit scores, what goes on behind the scenes in the credit, what's good for us, what's bad for us, how it affects us negatively, positively, and I'll let him take over.
I'm glad you know what I'm speaking about.
I do. I told him what to say.
Yeah. But but I do want the interaction. I do want to have the questions coming in. I prefer not to just ramble for 30 minutes. So I will take whatever you want to throw at us. And if I cannot answer it, we will get you an answer and we'll email you back specifically on it. To start off with, my name is Dean Adler. I'm with Hamilton Group Funding in Sunrise. I'm the branch manager of the Sunrise office. And I've been doing mortgages for over 25 years. It's how I met this lovely lady. I did her mortgage, and that's how we ended up meeting 26 years ago. Yeah, but I wanted to talk about credit in general, and we can get into some specifics of what's going on right now with forbearance and whatever other things people are doing that are making choices that may or may not affect their credit in the long run. But credit scores are interesting because it's a fairly solid system, yet, it's a fairly solid system, yet it's one that's misunderstood by a lot of people. So when I say misunderstood by a lot of people, a lot of us rely on credit karma or pulling credit ourselves in some fashion. Or maybe we go and we shop for a car and we end up getting one score and that they use, and we think that's our score. For mortgage purposes, unfortunately, it's not our score. There's well over 50 different variations of credit scores. So this is where a lot of the confusion comes in. And when you have someone calling and saying, hey, I've got a 750 credit score, we very well may not be talking about the same credit score at all unless they've had it pulled by a lender. So the most common one out there that people use is Credit Karma. And Credit Karma, just to understand a few things, and I'm going to be looking down at my notes periodically if I lose eye contact with you, but I want to make sure I cover the things that are most important of it. But Credit Karma is a for-profit organization. So despite the fact they're not charging the individual for pulling credit, what they are doing is gathering information on you between your credit report and knowing where you go and what you search. And there's advertisements that are targeted to you, and that's how they make their money. And they have over 40 million subscribers right now. So they're doing pretty well within their platform. Do they serve a purpose for somebody? Yeah, it's a good way to monitor your report as far as if something new pops up, if something erroneous pops up. It's a good thing to know. Does it serve you any purpose for really monitoring your score for purposes of mortgages? The answer is no. Unfortunately, not in the world that we're in right now, and people think that it does. And your score can be, averages probably 20 to 40 points difference in what your normal credit score is for mortgage purposes versus if we're talking about Credit Karma. And I've seen it as much as 80 and 100 points difference in what it is. Anybody have anything for as I keep going here? All right. So first of all, Credit Karma. We hear the word FICO a lot. Everybody's heard the word FICO, I'm sure. FICO score. What? Credit Karma uses something called Vantage Score. It's not even the same scoring system. Okay, so they're using something called Vantage Score versus FICO, which is used by over 90% of the lenders out there. Basically, if you're a Fannie Mae, Freddie Mac, FHA, VA, you're using FICO. You're not going to be using Vantage. So, drop the pen. So when you're doing when you're looking at your scores and you're using this Vantage Score, it is a whole different scoring system than FICO is. Then I'll take it one step further. Is they threw us a second curveball. I brought some props just in case, So they brought us a second. They threw us another curveball, and that's that within the FICO system, they've got numerous models within FICO. So when you're looking at, just for example, when you're looking at a FICO score for mortgage purposes, they use Equifax uses something called FICO number 5. Experian uses something called FICO number 2, and TransUnion uses FICO number 4. So even when you're looking at which FICO you're looking at, it varies based on those bureaus. So you say, okay, so I'll pull my FICO score. I got my FICO. I think there's myfico.com or one of the others that you can pull the FICO. Well, the score they give you when you're pulling that FICO score is not the scores that I just went over. You can get those scores, but you got to go deep back in there. You got to know which ones, and not to get too crazy on it, but there's just so many variations. They pull usually what's called FICO number 8, and that's not what's used by the mortgage industry. So, but within there, you can go in the back if you know how, and you can get to the scores that you want specifically. So when it comes to scores, as far as, I'll go a step further here. I'm sorry, some sidestep. Let's say you're going for a car. They use FICO Auto, most of them. The most common is FICO Auto Score number 8. If it's a credit card, it's FICO Bank Card number 8. Those aren't even the same models, okay? So long and short of it is, when it comes to credit, everything we're looking at is not the same. So we want to be careful, especially when we're dealing with somebody and in advance they're telling us, hey, this is my credit score, I just pulled it. Unless they just pulled it through another lending institution, it's not going to be the same, okay? So any questions off of that beyond where I've come from so far? Okay, I'm going to get into so scores and how it affects your rate, because that's another thing people want to know. Hey, how does my credit score affect my rate? When you're doing a conventional loan, let's start with that first. When we're doing a conventional loan, 740 becomes the magic number. Okay, 740 and above, and you're getting the same rate, the highest rate that you can possibly get. Okay. The lowest rate, the best rates that you can possibly get. Every 20-point increment from a 740 down is going to have a little bit of a hit to it. Okay, so it's going to be a little higher every increment down to 620. If we're looking at a conventional loan, 620 is the bottom line. You got to have at least a 620 to be qualifying, and you're going to go up. Once again, every 20-point increment is going to be a little better in the rate. Where that comes into play a step deeper is if you're not putting your 20% down, you got mortgage insurance. And the mortgage insurance, years ago, like 10 years ago, I don't know when they changed it, frankly. There used to be flat out, if you put down 10%, this was your mortgage insurance. If you put down 5%, this was mortgage percent-wise. This was going to be your mortgage insurance. Right now, it is a sliding scale based on your credit score, how many borrowers. 2 borrowers get a little better than 1 borrower gets because they're looking at risk-based now. Above a 740, they'll even price better with MI when it comes to 760, 780. So when we run mortgage insurance for a client, for example, we get 6 different prices that are going to come out, so we know where the best pricing is available in one shot. Okay, so that's on a conventional end of things. Now, on an FHA and a VA, there's a lot more flexibility, except right now. All right, so FHA and VA, typically you could go down 580. There are even programs where even lower scores than that. But because of everything that's going on and a lot of the forbearance that's occurring right now, the last numbers I heard is 7.5% of the mortgage holders have filed, mortgagees filed for, mortgagors have filed for forbearance. So we're going to see an effect on that, and the biggest effect you're going to see is for your FHA type of loans, which normally have a higher default rate. So what you're seeing is tightening up. Some lenders are not doing below a 680, some it's a 660. It's still available out there as low as a 580 I've seen, but it's going to vary lender to lender, and you're going to be paying considerably more in an interest rate than you did prior to that.
We have a question from Kenneth.
All right.
He wants to know, so do these online companies such as Rocket use the FICO, or are they being based on Vantage, just because the quote rates that seem much lower, and how do they compete against that?
Okay. Well, as far as the credit scores, if they're lending, they're lending Fannie Mae and Freddie Mac and FHA, so they're going to be using FICO. As far as what seems lower, you're talking about rates that seem lower, or the scores are coming in lower, or what are you seeing? Hold on.
Let
me unmute him.
Yeah, press,
Yeah,
or he can
you
press.
No, I unmuted. Go ahead, Kenneth.
Okay. So what I'm finding out is my friend who is in trying to get these things done through, because they're the title company. They're saying that mortgage, Rocket Mortgage, is like the #1 competitor against all their lenders right now. And he said it's because they're quoting these rates that are a lot lower than what, the mortgage servicing companies or private individuals that are doing the mortgage loan originations are. So my question was, are they using those fake scores just to give those people those rates, and then turn around and when it comes time to close, they're points higher than what they should be?
No.
And how are you combating that?
Yeah. Well, first of all, they're using FICO scores. They're going to be using FICO scores, and it's their level of the biggest thing with them, and I'm just going to go with general here and from things I've seen. Number one is got to read the small print on their stuff, because they go vague in some areas. They tend to be priced better than most places out there, not better than everybody, because we have X amount of flexibility. It depends on what we're doing. I mean, I've beaten them out before. They've hopped over me before. They've got things that they can do, and I got to decide whether I'm going to, how much I can battle, or whether I can battle or not. But I tend to, personally, I tend to be very conscious of rates, and I keep things out. Everybody's different. How much are you making? We kind of pick buckets we're in, though. One of the reasons I went the route of being a branch manager, because as a branch manager, it gives me flexibility. It's a little different world behind the scenes, but it gives me flexibility within the pricing. So on the competitive level, it varies out there like anything else. We're getting the money from the same place as Quicken. I will see Quicken come in here when I'm here, but then they'll sometimes go like this. Sometimes I'm flat out, we'll beat them. I mean, on a personal level. As an overall level, I would say that they're most aggressive in the market. But one thing, and you got to realize, and this is the thing, we hate to be treated like a commodity, like everybody's the same. And when you're calling over to Quicken, you have no idea who you're getting and who you're dealing with. Is it something that's been around for 2 months, 2 years, or 20 years? Do they, do they know what they're doing, on what level they know what they're doing? Can they put a transaction together? I had a transaction that I did that they literally had declined, and I was able to put it together. Was it because I could look at things different from the years of experience, or had other whatever it is? There are times. So, but question being, yeah, they're going to be using the FICOs. They're not using fake scores. It's not where they're coming from. And they're extremely on the competitive side of the market, but that doesn't mean they're going to be the best of it all the time. And what are you getting in return for it? Do you know who you're getting out there? So I'm shaking the
Right. Okay.
Okay. All right.
Thank you very much.
You're welcome. Yeah. I don't have short answers to anything, so it's it's all good. All right. Now, so when it comes to FHA, we're seeing more tightening right now in the government loans in Ginnie Mae, which is FHA and VA, as opposed to conventional, and a lot of that has to do with VA has the lowest default level, FHA has the highest default level, but they're both considered, they're Ginnie Mae. That's who's behind the scene on that. That's the secondary market on that. So what's happening is they're being lumped together, and because of the foreclosures, the forbearances, forbearances right now, because of the low down, because they, you don't have to have reserves as a norm when you're doing that loan. They've tightened up a lot on the thing. So you're going to start to see things where you have right now, some places, as a matter of fact, Quicken was one of the first ones I heard that went to a 680 on that. I don't know if they're still there. I know that some of the places that tightened up are starting to loosen up. Like you've seen that Chase has gone to a 720, a 700, and will only do 80% loans. I mean, you're going to start to see things loosen up, I think, based on some positive feelings that are going on. Whether they're warranted or not, we'll see. But I'll take the Gloria's question.
Yeah. Says Dean, we know you're a magician, but if a client had late on a few bills due to the situation that we're going through during this difficult time, what does that mean? What does that mean for them?
Yeah. So there are some things that we've yet to play out and how it's going to be handled. But right now, if it affects your credit score negatively, and we're credit score driven, some people think back, and Gloria's been worked Bank of America worked at Bank of America a long time. And even if I go back to the beginning of when I did it, so anybody that's been around for a while, used to be able to write a letter while you had the lates. They didn't have credit scores when I started. So it's like we weren't looking to that. Now credit scores are a hard line number. If the guideline says 620 and you have a 619, you're not doing a loan. If the rates are better at 740 and you have a 739, you're not getting the better rate. So when it comes down to it right now, and this is the thing, things have trickled down from above, government-wise, without everything being set up to specifically how it's going to be implemented. So there are different banks that are implementing things in different ways. I think I said last week, despite the fact that forbearance is it's not a late on your credit report, but if they list the word forbearance, which a lot of the institutions are doing, people have been seeing 60, 70 point credit drops in that. So if you have other lates that are within that, if that's being reported that way, unless it's something that the specific company's doing, like you call your auto company, car payment company, and they say, hey, we're not going to report you, we're giving you a couple of months or whatever, that's a different story. But right now, if it's reported and it affects you, it's going to affect you. We'll see what gets implemented as time goes on. We're in a fluidly changing situation, and how they're going to handle certain things, because things that were rolled out were not told, let's say, to the credit bureaus, hey, Equifax, TransUnion, and Experian, you have to do this. Well, there's nothing that says that I've heard of at this point. So it's going to be whatever the institutions are reporting. If that's the word forbearance and it's creating a problem, or if it's the word, that forbearance on a car payment, these are things that are going to have negative effects depending on how the way they're reported, and it's not black and white yet.
All right, we have a comment here from Candace. She says it's not a question, but she wants to, it says, Quicken and Rocket are not going to think outside the box. They're not going to offer an option on debt consolidation, and they don't fully underwrite. Remember, most likely it seems too good to be true. It probably is. The Dean Adler team are mortgage advisors, and is not always about the rate to get the best loan.
Thank you, Candace.
Very true. Very true.
I like when she speaks for me. No, but there is a, you know, validity in that, and not, you know, this is, there's more to this industry than that. Otherwise, we could just step over to anybody to do your loan out there as well as over there, you know, and that's just not the way the world works well, right?
Quick question.
Yes.
So what's considered a very good score in your credit to obtain one of the best, you know, loan programs out there with the best rate right now versus someone who's borderline, and then what's considered bad?
So 740, once again, is a magic number on a conventional loan. If you're doing FHA or VA, frankly, anything above a 680 has been solid enough. And it's been where you're not getting penalized for, let's say, coming in a little, you know, by getting hit with lower rates. You might get a fraction better. On a conventional, once you're dropping below that 740, there are little hits. When you drop below that 680, it starts to expand a little in how bad you get hit. And once again, if you're putting less than 20% down, that will affect you greatly. If you're putting down 30%, 40%, it starts to balance out the rate. So if you have a situation, even on, let's say, a refinance and a rate and term, and it's at a 60% loan to value, maybe someone with a 640 is not going to get smacked the same. So you're going to get closer to what you would on a 740 if you're in that situation. Government stuff, once again, becomes a bit different. We can go a lot lower, but once you're below 620, it starts getting more and more expensive. Right now, you know, some places, like I said, 640, 660 are even becoming a problem, but we can get it done one way or the other.
Any other questions? Feel
okay.
free to speak up if you do have a question by pressing the space bar, holding it down as you're speaking. We'd love to hear from everybody out there. We got some realtors on the call, and anything that concerns you or that you want Dean to clarify, or even if it's just something that you want to point out that you come across all the time. Okay. Maybe it's something we could.
Well, that's waiting. I'm going to go into one other area, and it's credit simulation. It's rescores, rapid rescores, and simulation. So I mentioned before, if somebody has a 739, if somebody has a 619, things like that. When we run credit, we're able to see in the back of the report something that tells us, hey, we can get this score up higher. Okay, so it might give, somebody might have a let's say somebody had a 680 or 679, and I may go to the back of the report and I see, hey, I can get it to as high as a 720, but I could get it to a 680, 700, 720. So what I'm going to do is I'm going to run a simulator that's going to tell me if we do certain things, it might be paying down some debt. And the reason I'm going to look at the 680 is going to be a lot cheaper versus a 700 versus 720. And sometimes it's just paying down a little bit of debt. Also, and this has come up multiple times in the last month with people, is that there are medical collections. Medical collections are the easiest collections to get deleted. Okay, it's often going to be paying to get it deleted, but not just paying it off. And these are substantial, because if you have a recent medical collection, especially recent, it could be a 60, 70, 80 point hit. And I'm talking for a $50 medical collection. It doesn't matter how much it is, it's new, or it's a few months old. And most of the collection agencies in this case will delete it. If you call, you tell them, hey, I didn't know I had this bill, because most people frankly don't. Most, whether it was that you never got a bill in the mail, you never was told it was going into collection, they just want the money, okay? And they'll send you a letter that will, a copy of the letter that they're going to send to the credit report. If we get that letter in our hands, we can expedite things. It does cost $35, $40 per bureau to do it, but it well becomes worth it for a 50, 60, 70 point jump. So between paying down some debt and getting rid of a potential collection or something negative that we can get rid of, and not everything can you get rid of, but especially those collections, we can see a substantial move. And I had one guy that when I started with him, and I knew I was going to get him up to a good level, but we went from the mid 600s, the mid 500s to over 700. It was actually 580s to 740, right on the nose we hit it. And we did it during the period of time from when he found a place till we closed, okay? I mean, they had gotten money from the sale of their house, so they had money to pay down on things. And there were a couple of medical collections that they followed our instructions on. And we went from a bad priced FHA loan to a beautifully priced conventional loan, from starting it to finishing it. Love those stories, and they happen as long as you pay attention to them. Will Quicken pay attention to them? I don't know.
When you do a credit simulation, would that be a time also where you could actually negotiate like a certain debt? Like, let's say it's a medical collection.
Yeah.
Right?
They may negotiate, but frankly, they've got you in a position, it all depends. I mean, every collection agency is different. And once again, medical are the easier ones. There are other ones that will delete, but medical is like, theirs is the easiest to get done. All right. Anybody else? Anything else?
Brian wants to know, what about disputes on credit?
Yeah, and thank you, Brian, because I actually had that up. So help me, right there in my handwritten notes. Disputes are something that we want to pay attention to, because disputes affect your score. They actually block the negative, so your score appears to be better than it is, and we've got to get that dispute removed 9 out of 10 times. Okay, there's occasional time that a conventional loan won't require it if it's a zero balance and maybe it's older, but aside from that, we've got to remove those disputes. So if somebody has a dispute, we run their credit, they got a 670 and they've got 3 disputes, and they're disputes that are recent and are and had lates, let's say, their score could drop 40, 50 points. And we'll simulate that prior, and we'll simulate then what else can we do to build it up simultaneously. But so we know what we're going to have when this occurs, but it is something that we do pay attention to. And in our system right now, this is brand new implemented, or we're double checking. I have 2 people sign off on that. Every dispute has been checked, and make sure, we don't want to have a surprise like, oops, we missed the dispute, So it's something that that does have an effect. And if you have a dispute, you're getting a false reading on your number. All right. Well,
Kind of wraps it up.
it's 1:30. It's perfectly 30 minutes. Unless anybody has anything last they want to say or speak, we'll get a recording out. I'll let you wrap up.
We'll unmute everyone for 2 seconds, and everybody say bye.
Bye, guys.
Bye.
Happy Wednesday.
Thank you.
Thank you very much.
everybody.
Have a great day.
All right.